The M&A market is on fire right now in South Africa. Retail and consumer brands markets are clearly leading the pack. In a landmark deal, Woolworths Holding announces its intention to acquire 100% of prepared foods manufacturer Into Food, which generates over 5 billion in annual revenue, has been a key supplier to Woolworths for over the last 3 decades. This acquisition brings a critical strategic capability in-house, securing Woolworths' premium food proposition and supply chain for high-quality convenience foods. This deal also represents a successful exit for Old Mutual Private Equity, which has been a shareholder of Into Food for a number of years. This is quite an incredible move, and wishing the parties involved in that incredible success. In yet another move that will reshape the FMCG landscape, Premier proposed acquisition of RFG, and that now has been recommended for approval by or to the Competition Commission. The deal, which values RFG at nearly 5.8 billion rands, or a little bit over $300 million, will create one of South Africa's largest food producers with a combined annual revenue of close to 30 billion rands, or a little bit over $2 billion. The merger, which brings together premier staple brands like Blue Ribbon and Iwisa with RFG's extensive convenience portfolio, the likes of Rhodes Quality, Bull Brand, and Magpie, will be creating a formidable competitor to the market leader within South Africa as well as the continent, and that is Tiger Brands. Yet another interesting opportunity is international interest in the South African market remains quite strong. Verum Beverages, major bottler of PepsiCo, is acquiring Crickley Dairy through its South African subsidiary for an enterprise value of around 238 million rands. This move is a clear strategy to diversify its product portfolio beyond carbonated soft drinks and into the growing value-added dairy and juice-based beverage category within South Africa. And on that note, let's get into it. Hello, everybody. I am Yongama Skweyiya, your pathfinder to entrepreneurial development and growth, and welcome back to the Core Podcast, where we distill the entrepreneurial journey to its core. As indicated, this has been a massive first quarter for the South African private equity and venture market space. I will not even speak about the pending secondary listing of Canal Plus on the JSE and the globally awaited IPO of SpaceX, but more on that in later episodes, as I have an axe to grind on the valuation, especially for that of SpaceX. And here we go. In investment, the deal is never only around capital. So what I want to talk to you a little bit this week is on deal making, deal structuring, and the nuances that are involved in the whole process. It is also about trust, judgment, and the kind of future the transaction is aimed at building. When ethics and integrity are missing at the structuring stage, values leak out long before the first report is written or the first milestone is measured. This episode explores why and the way a deal should be structured, and how this can either preserve value or quietly destroy it. So a few months ago, could be 8-9 weeks ago, so it's a little bit over 2 months ago, we met an interesting crowd out of Johannesburg that brought a decent opportunity our way. And as always, we dug deep to understand the deal, the mechanisms around it, as well as the environment or the market that the company plays in. Looking at the strength of the founding team, the veracity of its technology, the market share it currently has, as well as the growth prospects, we thought it's quite an interesting opportunity and we would want to be part of it. And based on all our understanding of the total addressable market or TAM, we were quite keen to be part of that. Now, anyone who's done more than a single deal will tell you that alignment of all parties involved in a deal is crucial. It seems obvious, but you will be quite surprised that partners on a deal are not always aligned as to the vision for the transaction and the expectations post transaction. What Zolani and I have come to realize and learn over time is that there is no clear barometer for universal ethics. People are generally on a spectrum, and depending on so many factors, would land anywhere between corrupt, gray area, and ethical behavior. For instance, we closed our small to medium enterprise fund or SME fund in mid 2025. This was a 200 million rand fund to look at underserved business owners already established, so not to go back to venture, but something more on the private equity side. The limited partners in that fund snubbed us when it came to the first drawdowns, not just single one, but all, as a consortium of limited partners. We later learned that the limited partners we had engaged with had few skeletons and are now being publicly aired in some of the commissions that are at play within South Africa. I digress. Let's get back to the deal alignment. Let's start with why integrity matters beyond ethics. There are three practical reasons. Firstly, value preservation. A structured alignment with reality prevents value destruction after the close of the deal. Imagine an earnout tied to ambiguous growth matrix. Disputes eat operating focus and the slow integration that comes out of that. This leads to destruction of value if not well managed. Secondly, predictability and execution. Clear, honest structures reduce disputes and litigation risks, speeding up integration and cash flow realization as everybody is in this to actually make some money. And lastly, reputation and access. Buyers and sellers who build consistent, transparent deals get better counterparties, better financing, and easier future exits. Integrity is thus in a deal. Structure means that the documents, the deal mechanisms need to be honestly reflected, that both sides understand their intentions are viewed, aerated, and understood, and fairly allocated risk across all parties so everybody is in alignment in terms of what is required, what their part is, and also the incentives for combined future value and growth. Now, in our lived example, we were brought into a deal that we did not know the genesis on and the mandates of that deal, but when the process started, we were approached. So, what was indicated and agreed upon with the sellers in the beginning was not something that we were privy to. So all we were told is that we were invited and this is we could participate and we can buy a portion into this deal, while the inviting parties would take care of the rest. Technically, this should have raised some apprehension on our part, but not if not full of red flags on its own. But we like to keep an open mind and not be judgmental towards other people. So we were open to hearing and listening and seeing how we could be of assistance to the parties that approached us as an invitation to this deal. We met with the third parties, brought together by the inviting party. When people meet for a transaction, they usually put their best foot forward. It's like a first date. Everyone shows you how pretty they are, how sweet they are, how everything they are, and we share stories of things we've done, their capabilities, the vastness of networks, who you worked with, where you worked, all those wonderful things to show that you deserve and you should be the one chosen in this partnership. So, in such instances, people will tell you all tall tales, usually generally true, but exaggerated to make them look far more superior or important in the deals that they've been part of in the past. So, we underwent this awkward blind date and decided we shall provisionally swipe right, as the slogan goes, on this partnership, largely because the deal sounded good. On the basis of the intrinsic value of the business, we were very happy with it. So, when information was shared with us, we realized that this is indeed a great asset, and even more, has great potential for growth into the future. When we entered the transaction, we did it for various reasons. Some, it was to gain influence. Others was to have ownership. Maybe another person might go into it to put in their life savings for a possible growth that they can retire on. Other people get into opportunities in order to retire, and others can do it as capital allocators looking for an upside to exit. Ours, we wanted to get into the transaction because we thought there's great value in it, and we try to put our best foot forward in order to get to that part. So each party comes with their own preconceived notion and tolerance levels. Some are logical, others not so much, and leaning more towards emotional. The only power or influence you have in such a situation and in all deals is over yourself. So you need to be present, you need to be logical, and you need to be practical. And focus on the big picture without compromising your ideals, integrity, and convictions. Now, let's delve into some of the most common pitfalls that erode structural integrity. Through many exits, there are only two that I would like to drill into. So, first one is hidden assumptions. Assumptions about market conditions, accounting treatments, or customer behavior must be explicit or they become contested later, especially when you get past the due diligence phase and you get to contracting and stuff like that. Everything that didn't make sense, the lawyers pick up and it makes the whole process drag on. So it's very important that all assumptions must be aerated. Then, and number two, poor documentation or pre-close agreements need to be aired and need to be said. So now, pre-close agreements are things like side letters, informal promises, or unwritten understandings or understandings where whether they are legal or practical hazards need to be said. So, if you promise someone, well, if we go into this deal, I'll buy you a car. These things need to be in the contract so everyone understands where we're coming from. So if you put all of the material in the agreement or into a controlled addendum, it makes life much easier for everyone. This, if not done, can trip you up, especially when you arrive at late stages of the transaction. So be cognizant of all side letters and informal promises that have been made. So now, back to my story. We had our meeting of the mind session, or the first date, as I indicated, to understand what each person would bring to the transaction. We indicated that we have a mandate to take up a significant minority in any transaction that we enter, and we only use equity as our tool. So we don't offer credit, we don't do weird things, we just exchange paper for paper, currency for equity. And that's the only kind of deals that we get involved in. And we generally look at an horizon of anywhere between 5 to 10 years as an investor in whatever that company is. This was all well received, and we subsequently were given access to the data room of the target business. So we developed our deal memo and started the process. Met with the management to understand the business and whether we want to work with the people at the helm. So it's one thing to look at financial statements and see what the business performance has been, and also to think about how this is in relation to the total addressable market and potential for growth. It's another thing to actually meet the individuals, sit across from them, and understand, are these the kind of people that you want to hang out with for the next 5 to 10 years, working with, trying to build with, executing a strategy with, getting into hectic conversations, sometimes arguments at either board level or wherever. And if you can't tick off that, yeah, no, I'm willing to tolerate these people, or I'm willing to work with these people, then you should not get into it. It's similar to marriage. You know at the beginning when you see the red flags, like, hey, this one is going to be a problem. Don't enter. So it's very important that when you get into a deal, don't just look at the financial aspects, but also you could look at the human side. Are these the kind of people that you want to be associated with? At every turn, we included the other parties because they were the people who invited us. We think it good manners that people that bring you to a particular place, that you are able to give them concise and concrete and full feedback so they know where things are. We thought of them as partners, and we were brought in because we could take up a significant minority stake, and they said they would take up the balance. And after all, they were the original holders of the mandate from the seller. They made a lot of assertions, promises, went into informal and formal agreements with the sellers, and a host of other claims that we still might not know today what they were, half of which they did not track or record to memory to be able to remember. but indications were that the sellers remembered all of them. For over a year, they had this mandate, and at six, at month 6 or so of not pulling the trigger or executing on the mandate, the seller opted to request an exclusivity fee of around 2 million from them in lieu of the opportunity cost of not talking to other people. This was only disclosed to us at a later stage, upon which we reiterated that we are not part of any prior commitments that we have entered into or promises that they had made with one another. Let's backtrack a bit to that conversation. During our meeting of the mind session, the third party, which is the one who held the mandate, or the one who introduced the mandate holders to us, informed us of this fee, but tells us, no, it's not important. I'm like, okay, cool. If it's not important, then it's not a major thing. So we let them know that we are not in any way willing to embark on such a transaction. And they indicated that it's something that we don't have to look into. It's on their side. We are bringing equity. They are raising debt. They will sort it out. We were happy. We're like, let's move on. During our session with the management, however, to see whether we like one another, the management indicated to us that the third party guys in the room, as we allowed them to be part of the conversation, after all, like I said, it was originally the deal, indicated that they had not yet received the fee and that this opportunity had been on the table for more than 6 months and that they had not shown any commitment to executing, and therefore they wanted their money. Of course, this took us by great surprise because this was actually the first time that this is a tangible thing to be raised. Because the first time we heard about it was, no, don't worry, it's nothing major. And now it was a foundational part of this particular deal. And we were taken quite aback. And here, as before, we realized the importance of getting all the information and all the details of the deal. Even more so, a good ethical investment process starts before term sheets are drafted. The right partner should be chosen for integrity, capability, alignment, and communication quality, not just the cash availability or the speed at which they can raise the cash or deploy the cash to the particular deal. An ethical deal is usually a clearer deal. And clarity, more often than not, is what always execution, that is what always makes execution happen. So it's quite an important part. There are also some incredible danger zones to avoid in getting into a deal. Do not structure a deal around unrealistic performance promises just to close the transaction, because you are merely kicking the can down the road. And a can that is kicked down the road gathers greater inertia that by the time you actually do address any of those things, it is bigger and worse than if you had actually addressed it in the beginning. Do not use complexity to hide risk. Do not transfer blame or obscure control. Do not accept partners who are charming but inconsistent, or financially strong but reputationally weak. and do not confuse urgency with quality. Ultimately, ethics and integrity in a deal structure or in deal structuring are not moral decorations. They are part of the investment thesis. They preserve value. They improve execution. They protect reputations and expand access to future opportunities. Because you know what? In a small town like South Africa, if you make a bad deal, people hear about it and don't want to work with you. And if you make good deals, people also hear about it and want to work with you in future. So the best deals are not simply those that can be signed, they are those that can be trusted, executed, and defended over time. And the right partner is not just someone who can fund the transaction, but someone whose conduct makes the transaction worth doing in the first place. And on that note, I will end our conversation. Needless to say, our transaction is still going on, but without the parties that brought us to the deal, that fell apart and new mandates were drawn up, and we'll see where we go with this. Until next time, keep dreaming, keep striving, and keep believing in the power of your vision. Form mutually beneficial partnerships with parties you share common beliefs with, and more importantly, that are on the same ethical plane as you are. This is Yongama Square signing off. See you in the next episode of the Core Podcast. Until next time, let's keep the core strong.